Okay, welcome back. We're going to get right into it. I'm your host, Lala Bunny, head trader at Bimbo Trading Academy. And the topic of today's video is trading halts and trading curb, which is also known as a circuit breaker or circuit breaker halt. Please watch part 1, and I'm going to continue on. So, what's a trading curb? That is when the entire exchange stops trading because the market has experienced a drop or several drops in value. Okay, so I'm going to go right ahead to the trading curb, to this entry on Wikipedia and get into it because there's a lot of fascinating details on here. So, a trading curb is known as a circuit breaker. It is a financial regulatory instrument that is in place to prevent stock market crashes. But please tune in to the end because it gets interesting. Because these curbs may not even be effective after all for the very thing that they're designed to do. Now, it is implemented by the relevant stock exchange organization. Since their inception, circuit breakers have been modified to prevent both speculative gains and dramatic losses within a small time frame. When triggered, circuit breakers either stop trading for a small amount of time or close trading early in order to allow accurate information to flow among market makers and for institutional traders to assess their positions and make rational decisions. In the United States, on the New York Stock Exchange, one type of trading curb is referred to as a circuit breaker. These limits were put in place beginning in January 1988, weeks after Black Monday occurred, which was the crash of 1987. In order to reduce market volatility and massive panic sell-offs, giving traders time to reconsider their transactions. The regulatory filing that makes circuit breakers mandatory on United States stocks exchanges is the Securities and Exchange Commission Rule 80B. So that's the SEC. It is there that the specifics of circuit breakers are elaborated and the various price limits are outlined for investors to see. The most recently updated amendment of Rule 80B went into effect on April 8, 2013, and has 3 tiers of thresholds that have different protocols for halting trading and closing the markets. At the start of each day, the NYSE, again, I don't know if that's how you say it. Let me know in the comments. I call it the NYSE. Sets 3 circuit breaker levels at levels of 7%, level 1, 13%, level 2, and 20%, level 3. These thresholds are the percentage drops in values that the S&P 500 index would have to suffer in order for a trading halt to occur. So again, remember, these were put in place after that. Was it called Black Monday? The crash of 1987. They were like, oh, we don't want this to happen again. So we put in these circuit breaker halts so that there's not this widespread panic that could lead to something like a Great Depression. Okay. Base price levels for which these thresholds will be applied are calculated daily based on the preceding trading day's closing value of the S&P 500. Depending on the point drop that happens and the time of day when it happens, different actions occur automatically. Level 1 and Level 2 declines result in a 15-minute trading halt unless they occur after 3:25 p.m. when no trading halts apply. A Level 3 decline results in trading being suspended for the remainder of the day. So if the S&P 500 drops more than 20%, that's it for the day. They're going to shut that down, resume trading tomorrow. Give people time to cool off. Circuit breakers are also in effect on the Chicago Mercantile Exchange, CME, and all subsidiary exchanges where the same thresholds that the NYSE has are applied to equity index futures trading. However, there is a CME specific price limit that prevents 7% increases and decreases in price during after hours trading. Okay, so this Chicago Mercantile Exchange also regulates after hours. Okay. Base prices for which the percentage thresholds are applied are derived from the weighted average price on the future during the preceding trading day's last 30 seconds of trading. Price limits for equity index and foreign exchange futures are posted on the CME website at the close of each trading session. So I'm not sure if I'm correct. And yeah, it's futures trading. So if you don't do that, it's not going to apply to you. But it's good to know. Okay. Should we keep going with this? All right, let's just keep it moving. Limit up, limit down plan. Now this prevents. Okay, let's try to figure out what this is. Okay, so there's another plan that does not just prevent. Oh, my dog moved my computer. It doesn't just prevent dramatic losses, but also speculative gains in a short amount of time. So this rule is put in place to combat security-specific volatility as opposed to market-wide volatility. Um, okay, so okay, so this would be each percentage change in value to occur within a 5-minute window in order for a trading halt to be enacted. That's what we were talking about before in the first video. So an individual stock will be halted if there is a 10% change in value of any security that is included in the S&P 500 index, the Russell 1000 index, and the Invesco Power Shares QQQ ETF. A 30% change in value of any security that has a price equal or greater than $1. So when penny stocks, oh no, that's above. Aha, a 50% change in value of any security that has a price less than $1. Okay, so when you're trading penny stocks and there's a change, so something under $1, which I know people say penny stocks are under $5, but for this definition, we're going with under $1. Truly penny stocks. Stocks that are like, let's say 15 cents, 20 cents, 40 cents, like that. Okay, so if those penny stocks fluctuate by more than 50%, up or down, it will get halted. But if the stock is worth $1 and up, any fluctuation above 30% up or down will get halted. So the criteria for halting is actually stricter. The criteria for halts is stricter for stocks above $1, and it's a little looser for stocks under $1. Okay. The previous trading day's closing price is used to determine which price range a specific security falls into. That's how they determine whether it's. So if a penny stock finished above $1 like the day before, then it can trade. Then it won't have. Oh, that's interesting. Which price range? Yeah, that's when the halts get annoying. Actually, uh, around that dollar mark. Yeah. Okay. Because no, I've traded and I've seen these halts. They're a little bit frustrating because you don't know when it's gonna get turned back on. You kind of have to watch and wait. All right. Founding. Following the stock market crash on October 19th, 1987, the current president, Ronald Reagan, assembled a task force on market mechanisms known as the Brady Commission to investigate the cause of the crash. The Brady Commission's report had 4 main findings, one of which stated that whatever regulatory agency was chosen to monitor equity markets should be responsible for designing and implementing price limit systems known as circuit breakers. The original intent of circuit breakers was not to prevent dramatic but fair price swings, rather to allow time for sufficient communication between traders and specialists. In the days leading up to the crash, price swings were dramatic but not crisis-like. However, on Black Monday, the crash was caused by lack of information flow through the markets, among other discrepancies, such as lack of uniform margin trading rules across different markets. Okay. And when have these... I'm going to have to pause it there, because I just want to make sure, this video is good before it gets messed up, and then I'll just do a part. So I'm going to go on to a part 3. This is exciting. Okay, I'll see you in part 3.